Something broke this week. The market just experienced one of the most violent rotations in recent memory. The Magnificent Seven stumbled, AI valuations cracked, and our portfolio? Well, that's the interesting part. Stick around because by the end of this video, you'll see exactly which stocks saved us and which ones hurt. Welcome to the weekly market and portfolio review for the week ending November 21st, 2025. I'm Burke. This week marked a turning point. The question isn't just what happened, it's what happens next. And whether your portfolio is positioned for what's coming. Let me show you the damage. The S&P 500 dropped 1.9% for the week. That's bad. The Nasdaq down 3.1%. That's worse. But here's what really caught my attention. The VIX, the market's fear gauge, spiked to 28.3 midweek. That's not just nervousness. That's fear. Now, before you panic, remember what we always talk about here. Volatility creates opportunity, but only if you understand what's actually, and that's what I'm breaking down for you today. Here's where it gets interesting. The S&P 500 equal weight index, only down 0.8%. Wait, the regular S&P was down 1.9%. The equal weight version only dropped half as much. What does that tell us? It means this wasn't a broad market sell-off. This was a concentration problem. The biggest stocks, the ones everyone owns, they're the ones that got hammered. Here's a stat that should concern you. Only 40% of S&P 500 stocks are trading above their 50-day moving average. Just a few weeks ago, that number was 80%. The market is getting weaker under the surface. Most people just don't see it yet, but it's showing up in our portfolio. And I'll show you exactly how in just a few minutes. Look at this chart. Really look at it. The Nasdaq 100 is up 16% year to date. Sounds great, right? But this week, down 3.1%. The S&P 500 equal weight is only up 8% for the year, but this week it only fell 0.8%. What's happening here is a classic rotation. Money is moving out of the expensive, crowded trades and into, well, that's what we need to talk about next. Because this rotation is playing right into our strategy. Defense wins championships. That old sports cliche? Turns out it's true in investing too. Healthcare led the market this week, up 1.8%. While everything else was falling, healthcare stocks climbed. Eli Lilly just became the first pharmaceutical company to hit $1 trillion market cap. Let that sink in. $1 trillion. The GLP-1 drugs, the weight loss medications, are driving massive demand. This isn't a fad. This is a structural shift in healthcare. Consumer staples also held up 0.8%. Walmart crushed earnings. People still need to eat. They still need household basics. But technology? Down 5.19%. That's a bloodbath. And it gets worse when you look at individual names, which we're about to do. Because some of our portfolio holdings got caught in this. Nvidia beat earnings. Let me say that again. Nvidia beat earnings. $57 billion in revenue, up 62.5% year over year. Data center revenue hit $51.2 billion. These are record numbers, absolute monster results. And the stock fell 11% from its recent highs. Jensen Huang, Nvidia's CEO, he put it perfectly. He said, the whole world would have fallen apart if Nvidia had delivered a bad quarter. Think about that. The bar is so high that even beating expectations isn't good enough anymore. The company raised Q4 guidance to $65 billion, and investors said, not good enough. This is what happens at market tops. Perfection is priced in, and anything less than perfection gets punished. Now, does this mean AI is dead? Absolutely not. But it does mean we're entering a new phase. The market wants to see profits, real returns, not just promises of future growth. And that affects our portfolio, which I'll show you in detail. But first, we need to look at the consumer. The American consumer is splitting in two. On one side, you've got Walmart, crushing it. CEO Doug McMillon said they're seeing robust performance across income segments. But here's the kicker. He specifically mentioned higher income households. Even wealthy people are shopping at Walmart now. Why? Because uncertainty makes everyone careful with money. When you're not sure what's coming next, you go for value. Now flip to the other side. Home Depot missed expectations, lowered their full-year outlook. CEO Ted Decker blamed consumer uncertainty and continued pressure in housing. Big-ticket items, home renovations, major purchases, those are getting delayed. This tells us something critical about the economy. People will spend on necessities, but they're pulling back on discretionary spending. And that pattern, it's showing up in our portfolio too. Some of our stocks benefit from this trend. Others, not so much. We'll get to those names in just a minute. The Federal Reserve is divided. And when I say divided, I mean deeply, fundamentally split. They cut rates by 25 basis points. Rates now sit at 3.75% to 4%. Sounds like they're on a clear path lower, right? Not so fast. The October FOMC minutes just came out, and they revealed something troubling. Many participants, that's Fed speak for a lot of voting members, indicated they don't want any more cuts until 2025. Let that sink in. We're in November. December's meeting is in 3 weeks, and the odds of a December cut? They fluctuated all week. On Friday, New York Fed President John Williams helped boost those odds to 65%. But here's the problem. Inflation is still running at 3%. The Fed's target is 2%. That gap matters. As long as inflation stays sticky above 3%, the Fed has a credibility problem. They can't declare victory. So what does this mean for stocks? Uncertainty. The market hates uncertainty. And right now, the Fed is uncertainty personified. This is affecting how we're positioned, and you'll see that when we get to the portfolio. But we have one more major risk to cover. Thursday is Thanksgiving. Most of us will be eating turkey, watching football, enjoying time with family. But something else happens on Thursday. Something that could shake global markets. President Trump gave Ukraine an ultimatum, a 28-point peace proposal, and Ukraine has until Thanksgiving, November 27th, to respond. The demands are significant. Cede territory to Russia, pledge never to join NATO, accept major concessions. Ukrainian President Zelensky said his country is facing one of the most challenging periods in its history. That's not hyperbole, that's reality. Now, why does this matter for your portfolio? 2 scenarios. Scenario 1, Ukraine accepts. Markets breathe a sigh of relief. Risk on trade resumes. Tech could recover. Scenario 2, Ukraine rejects the deal. Or worse, the conflict escalates. Markets sell off. Defensive stocks, the ones that held up this week, they become even more valuable. We don't know which way this goes, but we do know it happens in 3 days, and we're positioned accordingly. Which brings us to what you've been waiting for, the portfolio. Let's look at our winners first. Remember that defensive rotation I mentioned? This is where it paid off for us. Our number 1 performer this week, Alphabet, up 8.4%. Why did Google surge while other tech stocks crashed? Gemini 3.0. They launched their latest AI model, and the market loves that Google is finally competing seriously in AI. But here's what I really like, the valuation. Forward PE of 23.5 times earnings. Expected intrinsic growth of 18.8%. Compare that to what we're about to see with some of our losing positions. Google is growing almost 19% a year, but you're only paying 23.5 times earnings. That's reasonable. Number 2, Merck, up 5.2%. This is pure defensive rotation. People wanted stable cash generators. Forward PE, 13 times. Expected growth, 12.8%. You're buying $1 of growth for about $1 in valuation. That's as fair as it gets. And in volatile markets, fair beats exciting every time. Number 3, Eli Lilly, up 3.4%. First pharmaceutical company ever to hit $1 trillion market cap. That happened this week. GLP-1 drugs are printing money. Now, I'll be honest, the valuation makes me nervous. Forward P of 58 times. That's expensive, but they're expected to grow earnings by 37% annually. If they can maintain that growth, the valuation works. If growth slows, this could get ugly fast. So those are our winners. Now let's talk about what hurt us. This is going to sting, but we need to face it head on. Our worst performer, AMD, down 17.4% for the week. Ouch. Why did AMD get destroyed? 2 reasons. First, the broad tech sell-off hit semiconductor stocks hardest. Second, and this is the bigger issue, the valuation just couldn't hold. AMD trades at 48 times forward earnings. To justify that premium, they need to grow earnings by 30.5% annually. Can they do it? Maybe. But the market is no longer giving them the benefit of the doubt. Number 2 worst, Microsoft, down 7.5%. Microsoft is a great company. I want to be clear about that. This isn't about quality, it's about price. At 33.5 times earnings, Microsoft needs sustained performance from Azure, from Copilot, from their AI initiatives. If any of those stumble, the stock has room to fall. 3rd worst, Amazon, down 6%. Here's what spooked investors. Amazon just announced they're raising $18 billion in debt. For what? AI infrastructure. Now that might turn out to be brilliant. AWS is their cash cow. AI could make it even more valuable. But investors see $18 billion in new debt, and they get nervous. At 38 times earnings, Amazon needs AWS to keep growing. There's no margin for error. And finally, Nvidia, down 5.9%. The company that beat earnings, grew revenue 62.5%, raised guidance, and still fell 6%. This is what happens when perfection is priced in. Forward PE, 36 times. Expected growth, 42%. Nvidia is actually fairly valued if they can maintain that growth. Big if. But the market isn't rewarding fair anymore. It wants cheap. So what do we do about all this? Let's look at what's coming next week. Next week is going to be crucial. 3 things to watch. First, economic data. We get consumer confidence on Tuesday, GDP second estimate on Wednesday, and the big one, PCE price index on Friday. The PCE is the Fed's preferred inflation measure. If it comes in hot, above 3%, that December rate cut is off the table. If it comes in closer to 2.5%, markets rally. Second thing to watch, retail sales. Black Friday starts Thursday night. Cyber Monday hits next week. We'll get early reads on consumer spending. Are people actually buying or just browsing? Third, the Ukraine deadline. Thursday, Thanksgiving Day. We'll know Ukraine's response. Here's the bull case. Tech stabilizes. PCE comes in soft. December rate cut gets locked in. Ukraine accepts the deal. Markets rally into year-end. And the bear case? Tech keeps falling. PCE stays hot. No rate cut. Ukraine rejects the deal. Conflict escalates. Defensive stocks are your only safe haven. We're prepared for both scenarios. Our defensive positions prove their value this week, but we're not making any dramatic moves. Which brings me to the final slide. Let's bring this all together. 4 things you need to remember. Takeaway number 1, mega cap vulnerability is real. The Magnificent Seven drove the market down. Not up, down. When 30% of the S&P 500's weight is in 7 stocks, that's concentration risk, and we just saw what that looks like. AI valuations are being questioned, not AI as a technology, the valuations. Big difference. Takeaway number 2, defense won this week. Healthcare up 1.8%. Consumer staples up 0.83%, while technology fell 5.2%. Eli Lilly hit $1 trillion. That's not luck. That's a secular trend in healthcare. Our defensive position saved us this week. Merck, Eli Lilly, even Google, which is less volatile than pure AI plays. They cushioned the blow. Takeaway number 3, the Fed path is uncertain. Deep divisions among policymakers. Inflation still at 3%. December cut odds at 65%. But here's what matters. The Fed has lost control of the narrative. Markets don't know what to expect. And uncertainty kills bull markets. We're not betting on rate cuts. We're positioned for a range of outcomes. That's how you survive volatility. Takeaway number 4, geopolitical risk is elevated. Ukraine deadline this Thursday. This is a binary event. Either markets breathe easier or risk off accelerates. We can't control geopolitics, but we can control how we're positioned. And right now, we're balanced. So what's the bottom line? This was a tough week for growth stocks, an excellent week for defensive positioning, and a preview of what's probably coming. We're entering a phase where stock picking matters more than market timing, where valuation matters more than narrative, where issues of patience are more than predictions. If you're a serious long-term investor, if you want to understand how to position for what's coming next, if you're wondering whether your current portfolio is built for this environment, we should talk. The link to schedule a free consultation is in the description. No sales pitch, no pressure, just a conversation about whether the approach we use here, value-based management, looking at fundamentals, ignoring benchmarks, whether that might work for you. Thanks for watching. I'll see you next week with another market update. Until then, stay focused on what you can control, your portfolio, your strategy, and your peace of mind.